Imagine a retail empire, a titan of industry, a place that captured the imagination and monopolized childhood joy for generations. Not a victim of changing tastes or dwindling demand, but brought to its knees by an invisible, relentless foe, financial shackles. This wasn't a story of market failure, but of a balance sheet weaponized, and a company starved of the very capital it needed to survive. This is the story of Toys R Us, and how a private equity Gambit turned a retail giant into dust. For decades, Toys R Us reigned supreme, an undisputed category killer. Its iconic mascot and labyrinthine aisles were synonymous with childhood dreams. Yet beneath this seemingly impregnable fortress, a financial storm was brewing, not from market shifts, but from a strategic play designed to extract value, regardless of the cost to the core business. We're about to deconstruct how a masterful and ultimately fatal game of financial chess was played with this retail behemoth, leading to its shocking collapse. Let's rewind to the era of Toys R Us's unchallenged supremacy. From its inception, the company pioneered a strategic advantage: massive inventory held in vast warehouse-style stores. This allowed them to offer an unparalleled selection at ruthlessly competitive prices, systematically undercutting and destroying smaller, independent toy shops. It wasn't just a store, it was an experience, a destination. This strategy cemented its position as the ultimate category killer in toy retail. Their growth was exponential, their expansion global. Data streams from that era would visualize their market share as a rapidly expanding territory on the chessboard, gobbling up competitors with each strategic move. They became an almost unassailable fortress, a retail institution that defined entire generations of childhoods. Their strategic model was simple, effective, and deeply entrenched in the market. The year 2005 marked the beginning of the end, though few saw it at the time. Toys R Us, despite its market dominance, was taken private in a leveraged buyout, or LBO, by a consortium of private equity firms, KKR, Bain Capital, and Vornado Realty Trust. This wasn't a standard acquisition, it was a complex financial maneuver. The very assets of Toys R Us, its stores, its inventory, its brand, were used as collateral to borrow over $5 billion. This colossal debt was then loaded onto the company's own balance sheet. This is the art of obfuscation in its purest form. Suddenly, a healthy, profitable retailer was saddled with an annual interest payment of hundreds of millions of dollars. The isometric data streams vividly illustrate this. Imagine the company's revenue flowing in, only to be immediately siphoned off, not for product development or store improvements, but to service this crushing debt. The core business, the very engine of Toys R Us, was being systematically starved of capital. The private equity firms prioritized financial extraction. Their focus was not on retail innovation, e-commerce development, or enhancing the customer experience. It was on restructuring the debt, optimizing for a quick return on their investment, often through dividends paid out from the company's own assets. While competitors like Amazon invested heavily in their digital infrastructure and logistics, Toys R Us couldn't. Every dollar that could have fortified its future was instead swallowed by interest payments, a strategic miscalculation born from the Boardroom's prioritization of financial engineering over the needs of a thriving retail operation. The debt burden wasn't just a theoretical financial strain, it manifested in fatal strategic errors. While online retail surged, Toys R Us was handicapped. They simply couldn't afford to invest in the cutting-edge e-commerce platforms and logistics infrastructure that Amazon was building. In a desperate early move, they even disastrously outsourced their online operations to Amazon itself, effectively training their future executioner. As the retail landscape shifted rapidly, Toys R Us found itself unable to adapt. Its stores became dated, its inventory management struggled, and it couldn't compete with the seamless online experience offered by digital rivals. The glowing red chains visibly crushing the metallic castle symbolized this excruciating pressure. Each passing year the competition grew fiercer, while Toys R Us, shackled by debt, watched helplessly, unable to make the necessary strategic investments in store upgrades, employee retention, or an integrated online presence. The market was changing, but the company's balance sheet had been weaponized against its ability to evolve. By 2017, the unsustainable became unavoidable. The relentless pressure of debt service, combined with intense competition and the inability to modernize, forced Toys R Us into Chapter 11 bankruptcy. This wasn't merely a restructuring, it was a prelude to the inevitable. Despite attempts to reorganize, the financial burden was simply too great. The once mighty castle piece, symbolizing a retail empire, had been systematically weakened, starved, and ultimately crushed by the very financial mechanisms meant to optimize its value. In 2018, the unthinkable happened. Toys R Us announced its global liquidation. Stores closed their doors for good, and millions of children watched as a beloved institution vanished, not due to a lack of demand for toys, but because of a balance sheet that had become a financial death sentence. The collapse of Toys R Us serves as a chilling testament to the predatory nature of certain financial engineering tactics. It's a stark reminder that even the most dominant brands, cherished by millions, cannot survive when their balance sheets are weaponized against them. This wasn't a case of a business failing to adapt to market shifts. It was a company literally starved of oxygen by the very debt structure imposed upon it. The sobering truth is, Toys R Us didn't die because children stopped buying toys. It died because complex Wall Street debt structures literally stripped it of the cash needed to innovate, compete, and ultimately survive. Join us next time on the Boardroom Gambit as we delve into the intricate deceptions of the crypto house of mirrors, unraveling the FTX illusion. If this analysis of the private equity plunder of Toys R Us resonated with you, be sure to like this video, share it with your colleagues and friends, and subscribe to the Boardroom Gambit for more strategic insights into the plays that shape our world.